I will be speaking in English, just as a heads up. So I'd like to start first by thanking the Finovate team so much for hosting us. It's been an incredible event so far, and certainly look forward to speaking with all of you after this session. My name is Lisa Nestor, and I help lead partnerships at Stellar. Stellar is a San Francisco-based company. We're a mature startup, I would say, and we have a blockchain-based protocol, which I'm going to tell you a lot about. But I'm going to wait, actually, until the end, save the best for last. And I want to start by providing kind of a general introduction to the opportunity around blockchain and financial services. So I'd like to start by defining a term, friction cost. So friction cost is basically the cost, either direct or indirect, associated with executing a financial transaction, right? I like to think that friction cost is the dog food of blockchain. It's what it's out there to eat and take down. So why is that? Well, examples of friction costs are things like transaction fees for sending a payment, exchange fees, loan origination fees, commissions for doing maybe a stock purchase or trade, holding an escrow account, having a notary, all these different fees that come just for wanting to execute a transaction, right? And it's estimated that in 2014, there was close to $1.7 trillion paid just in these friction cost activities, right? Now, of course, that's somebody's salary, but I think that we can all agree that the industry as a whole would be better if we had less of these frictions, right? If it was easier to do financial transactions. But I just want to add a little bit more context to this, because I think that as in the financial industry, we tend to really insulate ourselves and be very focused on how hard or how easy it is to do certain things. So just to make this a little bit broader, right now, we're figuring out how to launch rockets into space and have them come back and land on the ground in one piece. We are figuring out how to make self-driving cars. We're on the cusp of understanding artificial intelligence. We're using things like CRISPR to mess around with our genes, our DNA, and yet it still costs me $30 to debit an account in my US bank account and credit an account in a French bank account. So we're never, my belief is we're never really going to be able to achieve the immensity of human science and technological potential until we as an industry, as a financial industry, figure out how to build an infrastructure and ecosystem that can support that. So that's why we want to take down friction costs, right? I hope we're all kind of pumped up about this now. So again, inefficient infrastructure, and this is really about infrastructure, leads to friction. And friction leads to increased costs and reduced opportunity in our industry. So let's figure out how to remove some of these. So how can we do that? How can we reduce friction costs? Well, you may guess, I'm going to talk about blockchain, but first let's talk about at least my thesis. 3 things that we essentially need in order to kind of reduce these friction costs. The first, we need the ability to do trustless transactions. And when I say trustless transactions, I don't mean like Silk Road, black market money. What I mean is the ability to transact business to business, person to person, institution to institution, without having a third party sit in the middle, without having to necessarily know each other and have a pre-existing relationship. An ability for me to be able to send money to you right now. I don't have to trust you to do that, right? So how can we enable trustless transactions? 2, we need institutional and network interoperability. This is fundamental, and it's something that we so lack in this industry right now. You either have the correspondent banking system, which is a handful of banks that are facilitating movement of funds internationally for an entire ecosystem of banks, Or you have gated private networks that say, sure, I'll help you send money instantly from country A to country B or to do some type of transaction, but you're going to pay for that because it's a private network, right? And I think a really good example to kind of bring this home is email. And I'm going to talk about email later, but the idea that for me to be able to send you a free and instant message, you would also have to be a Gmail subscriber, right? I could only send emails to other people who are at gmail.com. It's ridiculous, right? The idea that if I wanted to send an email to at finovate.com, I had to pay something or there was a delay in doing that. That's crazy. And think about how much more inefficient our economy would be if that existed. But that's exactly how the financial industry exists today. You can't easily interoperate or move transactions or funds or execute trades between institutions and network. There's this kind of laborious process to get there. And so the way we get that interoperability is by accepting global standards. So this is really critical. And I think that this is what blockchain can enable us to do. Email uses SMTP. That's how different email servers have agreed to communicate with each other so that we can send email messages really fast, seamlessly to each other. And so what we're on the cusp of, I hope, is having some type of standard protocol in order to facilitate interoperability between our financial transactions. Okay, so I'm going to give a little bit of an overview of blockchain distributed ledger technology. I want to start, though, with this picture, because I think a lot of times people imagine something more complex than it needs to be. So if this icon looks a bit like the internet to you, it should. Blockchain is internet-level technology. It is a network layer that is hosted by servers, we call them validators or nodes, all over the world. And these servers within this ledger are hosting a ledger, or sorry, within this network are hosting a ledger, hence the phrase distributed ledger. So basically, distributed ledger technology allows you to securely transmit any type of information without the control of a central authority, right? Going back to this idea of trustless transactions. So when we look at our traditional system, right, our traditional ecosystem tends to be centralized. You can think of things like SWIFT, right, or the correspondent banking method. Another great example is credit scores. Right now in San Francisco, if I'm applying to an apartment and they want to look at my credit score, they have to pay a fee to some agency that holds my credit score, right? The centralized agency, it's not available. What that also means when you have a centralized authority is that you have a single point of failure. How many times was SWIFT hacked in the last year or two? I think at least twice, because it's a giant red target. It's a single central authority for attackers to go after. And this also means that it's trust-based, right? Again, so you have to have this intermediary who's enabling the transaction. When you look at something like blockchain, it's using what we call a decentralized architecture. So that means that, again, you have many different authorities or many different servers that are all hosting this network. So if one goes down, guess what? There's 100 more. It makes it more resilient as an architecture in general. There's no single point of failure. And it's trustless. Again, you're able to transact directly peer-to-peer. Now, how do you do that? So because you have a decentralized architecture, it means that with this distributed ledger, each validator or node on the network actually maintains its own copy of the ledger. So think about all those computers all over the world, and they're maintaining a ledger, a history of transactions. And actually, each validator holds its own version of the ledger. And they speak to each other, and they're constantly in consensus, making sure they have the same kind of current state of the world with their ledger that they're each holding. And so this does two things. One, it eliminates the need for intermediaries because there's this network layer with a ledger that everybody has. So suddenly there's universal access and visibility into information, into current account balances, into transaction history. Two, it allows institutions to interoperate Because there is a shared ledger, suddenly, if I'm on that ledger and you're on that ledger, I can immediately send a transaction or piece of information to you. I don't have to go through any third parties. This is really exciting architecture and information that we now have available to us. Now, the consensus within the blockchain architecture is something that's really fundamentally important. And I would encourage you all to read more because I'm certainly not going to do it justice. But as I mentioned earlier, there's a network layer. There's validators that are supporting this network layer. And instead of the internet, this network layer has a ledger, right? Just like a bank ledger, but it's a shared universal ledger where everybody can see the transactions, the account balances, etc. Now, it's important that each one of these validators has the same copy of the ledger, right? That's what enables trust within this network. And the way that you achieve that is through consensus. So these validators are talking to each other every 2 to 5 seconds, making sure that they all have the same current state of the world. Now, when we think about something like Bitcoin, that's done through mining, right? That's something called proof of work. But that's not the only way to achieve consensus. There's actually some very interesting applications that have come out in the last 2 or 3 years. For example, my company, Stellar, uses our own consensus algorithm, something called the Stellar Consensus Protocol, which is a different way that validators in the network can talk to each other. It actually allows for institutions to do validation with each other on the network, as opposed to something like Bitcoin where you have miners, right? So this is another important aspect. Again, each node on the network keeps a record of the ledger, syncing every 2 to 5 seconds, making the system more secure against attacks and corruption. Remember, if one of these validators gets knocked out, there's others. The current state of the world still exists. It's a more resilient infrastructure for our financial system. Also, and this is really important, activities on the network, they're stored chronologically, cryptographically, and it's append only. So what I mean by append only is you can only add to it, but you can't manipulate anything that's already occurred. I can't go back to yesterday's history of the ledger, a year ago's history of the ledger, and try to change a transaction history. Instead of you sending me 100, you send me 1,000,000. Because if you do that, it fundamentally affects the entire ledger history. And every other participant who's on that ledger will know. So because it's append only, and now everybody has their own copy of the ledger, you suddenly have financial infrastructure that's very secure and very reliable. Lastly, within the blockchain space, there's actually 2 different types of network designs, at least right now. You have public or permissionless ledgers, and you have permission ledgers. This is an important distinction to understand. The most famous permissionless ledger should be something you guys have all heard of. It's Bitcoin. What permissionless means is that anybody can kind of host a validator, host a server, and access this network and start submitting transactions. Other examples are Ethereum. Ethereum is also a permissionless ledger. On the other side, you have permission ledger, and permission means that there's still this universal shared ledger, but you have to be pre-approved. You have to be given permission in order to access it. Examples of this would be R3's Corda, Hyperledger's Fabric. Now, I would argue that there's actually use cases for both, right? They both have their own reasons for existence, but it's important to understand when to apply one and when to apply the other. All right, so I get to talk about Stellar now, which I'm better at doing. So Stellar has its own blockchain protocol. We have our own network layer, specifically designed to facilitate payments between the world's financial institutions. So a couple things I want to highlight here. One, although the technology can do a lot, we as an organization are very focused on the singular use case of payments. We want to help make payments move around the world much more seamlessly. Two, I want you to take a look at this picture again. So you can see the icon I used for blockchain network kind of in the middle there, which is then plugged into by institutions who then service their customers. So the important point to take away is Stellar is not customer facing. It's not something that you or I would suddenly open an account on and start using. It's something that institutions, our current financial infrastructure, can utilize in order to help it have a better infrastructure, a digital infrastructure, in order to move payments around the world. So to add a little context, why payments? Because I think this is actually really important. Number one, payments are fundamental to every type of transaction, financial transaction we execute. Whether it is buying a stock, making a trade, there's a payment involved. Certainly if I'm sending money, if you're giving a loan, I would hope that there's going to be some payment involved in this as well. Payments are really fundamental. They're the fundamental aspects of most of the types of financial transactions that we execute. Two, the world is changing in terms of the types of payments we want to facilitate. The current infrastructure of the correspondent banking model, which is 40 years old, it wasn't built to facilitate the type of payments we want to make today. It used to be these very high value payments sent infrequently, right? Low value. Now we want to do high volume payments that may have very little value. Maybe I want to send 50 cents to somebody to buy a cool sticker that they're going to mail to me. It doesn't matter. Particularly when we talk about our small and medium-sized businesses, maybe they used to operate locally, they're not anymore. They're operating globally, and so we need something that's able to manage these types of transactions. Two, payments aren't done by just banks anymore. We need a more flexible infrastructure that can facilitate interoperability with things like M-Pesa, with things like Paytm. I was just in India two months ago. Paytm, MobiKwik, FreeCharge, these companies didn't even exist 2 or 3 years ago, and now they have 600 million customers. I mean, it's insane. So we need to make sure that the fundamental infrastructure that enables payments is okay with enabling it via a bank, via a mobile wallet, a remittance company. We need something that's more flexible. And two, it's more likely than not now that you're going to make a multi-currency transaction than just a single currency transaction. Again, the world's a global place. But this is the big elephant in the room. And so I'd like to say that Stellar is very much a technology company, but we are also evangelists for financial inclusion. And I feel our role in the marketplace is to make sure that this financial technology helps everyone and not just some people. And a big reason for this is remittances. So it's estimated that about $600 billion was spent in remittances in 2014. And $44 billion of that, which is about 7%, was paid in fees. And that's an average, right? That's an average between the 2 or 3% that's paid in the US or Europe, and the 18 or 20% that's paid in order to send from Morocco to South Africa, right? And what's even more interesting is that the places that often receive the most remittances or are most dependent on remittances, they see the highest fees, right? This is money that's being directly taken out of the economy. But I think this figure is actually the most interesting. This volume, this number, 600 billion, it's about 3.5 times the size of international development aid given annually. So when you talk about how you want to lift people out of poverty, is it by making it easier for their friends and family members who they trust to be able to send them money in a cheap and fast way? Or is it depending on state governments to continually provide international aid? This is the way to go. It makes a really big difference. So remittances, it's a huge use case, it's low-hanging fruit, and it has immense impact to really better the world. So that's why it's something we're really focused on at Stellar. So I just quickly, I like this diagram, so I want to show it. This is what we're trying to do. On the left side, you see how email was before and after SMTP, right? So before, when you wanted to send a message to a friend via email, you had to route the payments through a couple different servers. They would have to figure out where it goes. It took a little while. With SMTP, it was this common protocol. You could put in the exact payment address location of where your destination was to be routed to, and it would go there, right? That's basically what we're trying to do with payments. Right now, maybe you have correspondent banks. There's many intermediaries in the way of trying to get a payment from country A to country B. With Stellar, we make this one simple flow, right? You put in the payment address of where you want to send it, and it ends up there. So that's what we're focused on doing, building an open financial network. So I'm going to quickly go over a couple of the core concepts of Stellar. And again, not all blockchain protocols are built the same. Sometimes I say they're like donuts, like they have different styles and flavors. So this should give you a good idea of how Stellar's blockchain protocol works. And keep in mind that we're very focused on payments. So everything we've built has been designed to facilitate particularly multi-asset or multi-currency payments. One, there's accounts and public keys. In order to start processing payments on the Stellar network, you have to open an account on the Stellar network. This is normally done at the institutional level. So a bank would open an account, a remittance company would open an account on the Stellar network. And you have a public key. This is a federated address. This is the place where people know to send money to, right? So this is how basically transaction moves from account to account in the Stellar network. Two, you have your ledger. As we discussed earlier, the ledger is what keeps the history of transactions. It's append only. It's what creates trust amongst people in the marketplace or on the network. Three, and this is really the most novel thing about Stellar, we basically have a built-in Forex or exchange platform as part of this network. So we have institutions called market makers, quite similar to market makers in the real world, who within Stellar, within this order book, list currencies that they're willing to do transactions for. So if I'm a market maker, maybe I like to do pesos to rupees and pesos to dollars. So I'll list the rate at which I'm willing to trade pesos for dollars in the Stellar network. And so that's what allows us to really seamlessly, very quickly and very cheaply move transactions across different currencies because it's all done within this distributed ledger framework. I've already hit some of these points, but again, in case I didn't mention this, Stellar is a public network. So we're not permissioned. You don't have to have pre-approval. In fact, we're also open source. All of our code is out in the world, and you could actually leave here tomorrow and start working on Stellar, building things on Stellar, and never tell us. That would be fine. We think that's really important because with payments, it's about the network effects. It's about being able to send money anywhere and everywhere. And so having a public network that's utilized by licensed and regulated financial institutions allows for the safety, perhaps, that we need in sending transactions, while also enabling the scale of the network to really grow. Stellar works within existing financial institution or infrastructure, right? So we're not Bitcoin. With Bitcoin, you can send money all around the world, but it's outside of banking. It's outside of remittance products. With Stellar, we actually have banks, remittance companies, payment companies integrate onto the network in order to process payments. We're multi-asset and multi-currency. Because we have a built-in order book, we can do exchanges between any asset or currency. That includes things like airtime minutes, bonds, stocks, you name it, you can put that inside of the Stellar network. If somebody is willing to make a market on it, you can trade it. And lastly, we have a lot of important technological features. One, the Stellar consensus protocol that's unique to us. Two, we also have capabilities like smart contracts. So for example, having multiple parties have to sign off for a transaction to be executed, or doing things like batching, where maybe there's a sequence of operations that need to be completed before a transaction is submitted to the ledger. And we also have something called a compliance protocol. This is basically a bilateral exchange of KYC and AML information between the institutions on the network that's verified prior to the transaction being submitted. This is miles ahead of how a lot of this stuff works today. Oftentimes it's one directional, you send the information, fingers crossed, everything goes through. With Stellar, all of that's done instantaneously and then the transaction's submitted. So I think this image is a really good summary image. Again, Amy goes to her institution, says that she wants to send money to her friend Tunde in Nigeria. Both institutions have integrated onto the Stellar network. First thing that happens, Amy's institution exchanges KYC and AML information with Tunde's institution. They kind of do a handshake, verify that everything's fine. They run the information against AML sanctions lists. After that's completed, the transaction is submitted into the Stellar network. The order book will then look and see what is the best rate that's available for the transaction that you want to submit. So if I want to go from pesos to rupees, it will look amongst all the market makers who are willing to do that transaction and tell me who's offering the best rate. Even more exciting, we have a concept called pathfinding. Perhaps the best rate isn't going directly from pesos to rupees. Maybe the best rate is going pesos to dollars to rupees. The Stellar network will tell you that. It actually looks at what is the best path in order to make this the cheapest and most efficient transaction. Again, I think something that's really great is that this technology allows us to leverage the infrastructure that we already have. Right now, a lot of payments companies have duplicative accounts all over the world where they have to float funds in multiple currencies just in order to do payouts. With the Stellar network, you can leverage the pay-in and pay-out capabilities of all the other institutions on the network, and then market makers can have a specialization in providing liquidity and market making on the network. The last point that I'd like to make is that this technology, it has a lot of implications. There's a lot of money going into blockchain right now, which is quite exciting. But it's our belief that in order to really achieve a universally adopted network, to really make the SMTP of payments, it's important that the platform is governed by a neutral party. For that reason, Stellar, the network, is governed by Stellar Development Foundation, my employer. We're a nonprofit foundation. A couple things about us. Our core charters are to maintain the code and to grow the network. Pretty simple. You come on, you say you want to join the Stellar network, I want to be able to send money to the Philippines. I'll try and find you some partners on the network who want to work with you. 2, we're open source, like we said. We want this to be scalable. We want this to be something any developer can pick up and start working on. Integration and use of the network is free. Processing transactions on the Stellar network is basically free. Now, institutions may apply a fee, or there may be some FX rate that's within there, but we don't charge any fee. There's no annual licensing fee, no transaction fee in order to utilize this technology. We see it as public infrastructure to move money around the world. And most importantly, the Stellar network is much bigger than just us. Because we've taken ourselves to just be the stewards of the protocol, we leave so much opportunity for businesses to grow on top of that. And that's what's exciting. We see ourselves as really growing an ecosystem because we're not trying to own the entire stack. Here are some of our partners. We're really focused right now in the Philippines, the GCC, West Africa, Europe, and India. And we'd love to get some activities going here in Latin America. Implications of a Stellar world. Imagine if you could send money for near free, have it settled in 3 to 5 seconds anywhere in the world. That's the implications of a Stellar-enabled world. And when we think about what people have built on open platforms, I think the best precedent is really the internet. And who could have imagined companies like Netflix, Amazon, Google? But those types of companies will emerge as we increasingly see adoption of open platforms like Stellar's blockchain protocol. I would encourage all of you to think big and get your hands dirty now. There's nothing stopping you from looking at the code and starting to explore what you can build on the Stellar network. Happy to discuss this further with anybody during the breaks, or you can email us at partners@stellar.org. Thank you.